Supermicro Computer, ticker SMCI, reports tonight with a contradiction. Revenue is tracking near the low end of guidance. Gross margin is preliminarily 15 to 17%, almost double the prior guide, and new orders exceeded $60 billion. The question is whether this is a durable margin turn or a favorable mix quarter hiding a cash conversion problem. My provisional answer: promising, not proven. Final margin and cash conversion must confirm it. That distinction matters because a company can have extraordinary demand and fragile economics at the same time. The headline can be true, while the investment conclusion is wrong. So rather than predict an earnings beat or miss, use tonight as a three-gate test: margin durability, order to revenue conversion, and working capital normalization. Start with what the headline says. Supermicro's July business update says backlog reached record levels and that more than $60 billion of new orders arrived during the quarter. That is real evidence of demand. But the same disclosure says those orders are expected to ship over future quarters, and some may not be firm commitments. They can be delayed or canceled. So the order number is not the finish line, it is the first test. That is not a reason to dismiss the $60 billion figure. It is a reason to ask what portion converts, when it converts, and at what economics. The first proof module is the margin contradiction. Back in May, Supermicro guided fourth quarter revenue between $11 and $12.5 billion. Then, on July 21st, management said revenue is tracking near the low end of that guidance. Normally, that would make the quarter look weaker, but the next line flips the story. Management estimated both GAAP and non-GAAP gross margin at 15 to 17% versus prior guidance of just 8.2 to 8.4%. And the company gave a direct explanation: favorable customer and product mix. That is a massive change in economics without a matching upside surprise in revenue. There are two ways to read it. The bullish interpretation is that Supermicro is moving toward a more profitable mix of AI infrastructure business. If that is what is happening, the margin rebound could be the beginning of a more profitable growth phase. But management has not disclosed the exact mix components, so investors should not assume which products or customers created the change. The cautious interpretation is just as important. A favorable mix can also be temporary. Large deployments can move between quarters, and customer timing can change which systems ship first. Supermicro has not yet shown how much of the 15 to 17% margin should be considered repeatable. That gives tonight's report its first gate. The final margin needs to hold near the preliminary range, and management needs to explain why the mix improvement can persist. Then comes the second gate. Those $60 billion of orders must start turning into reported revenue rather than remaining a future quarter headline. And that leads to the part of the story the order number cannot answer: cash. In the third quarter alone, Supermicro used about $6.6 billion of cash from operations. By March 31st, accounts receivable had climbed to about $8.4 billion, while inventory stood at roughly $11.1 billion. Neither number is automatically bad for a company scaling through a huge AI infrastructure cycle. In a fast-growing business, working capital can expand before the cash arrives. But that is exactly why the final earnings report matters. When demand is real and economics are improving, working capital eventually has to stop consuming cash faster than the business can replenish it. Receivables need to turn into collections. Inventory needs to turn into shipments, and profitable shipments need to turn into operating cash flow. This is where the story changes from does Supermicro have demand to what does Supermicro have to finance in order to satisfy that demand. The strongest bullish case is that the company is already crossing that bridge. Gross margin had recovered sequentially in the third quarter, and the preliminary fourth quarter range implies another large step up. If final results confirm that range, while inventory and receivables begin to normalize, then the favorable mix explanation stops looking like a one-quarter curiosity and starts looking like an operating shift. But if margins look great while cash conversion stays deeply negative, the thesis is not finished. The company may still be winning huge AI deployments, but investors would be financing a much heavier working capital machine than the order headline suggests. So here is the decision framework before the call. The bull case is simple. Final gross margin holds near 15 to 17%. The company gives credible evidence that the mix improvement is repeatable, and working capital begins moving toward cash conversion. The base case is more cautious. Demand remains extraordinary and the preliminary margin holds, but receivables and inventory stay elevated. That is a watch, not because the AI demand is fake, but because the economics still need to catch up with the orders. The bear case is not that $60 billion of new orders disappears overnight. It is that the margin rebound proves temporary, order timing keeps revenue uneven, and working capital continues absorbing cash. My verdict before Supermicro reports is watch the conversion, not the headline. I do not need SMCI to beat every number tonight. I need the final report to prove that favorable mix is becoming repeatable economics. If it does, the thesis changes. If it does not, $60 billion of new orders can still represent real AI demand and still fail the cash test. After the final numbers are out, the next step is to test exactly that, whether the 15 to 17% preliminary margin held, whether orders converted into revenue, and whether working capital finally moved in the right direction.